Hello, hello, and welcome to another coffee break. Today, we're going to discuss 5 things you should know about dealing with market volatility. We have definitely been seeing that a lot in the beginning of 2025, particularly in March. And a lot of people aren't sure how to handle it and what it really means and how to deal with their emotions when it comes to market volatility and the ups and downs. And we'll go through all of that in a second. So, we're going to talk about 5 things you should know to kind of keep those emotions under wrap. Now, before we get started, again, what is coffee break for anybody that is new? If you are not new and have watched this before, welcome back. Just bear with us for a second and we will get to the actual information. But Coffee Break is basically made for 401k participants. So if you are eligible for a 401k, you have a 401k at work, maybe you're putting one in your office or your business, that is for you. It is to get a quick peek at strategies to help for your financial future, short and sweet, 15 minutes max. I try to go under 15 minutes. The whole idea is you're supposed to be able to drink your coffee and watch the video in your coffee break, right? And today we're just going to cover highlights. So there's not going to be any information that you should take and put into place for yourself. You should use this to have conversations with the people that you have when it comes to financial decisions. If you don't have somebody and want to be able to have a deeper conversation with me or Chris, then you can go on to our website. There'll be some information at the end for you to contact us for a non-obligation call. Obviously, we don't make sure that you have that ability to talk to us without feeling like you have to work with us in the long run. And when I say Chris, who is Chris? Well, Chris Whalen is my business partner. He's been in the industry for probably 24 years plus now. Works a lot with employers to implement benefits, all this kind of stuff that you deal with at work. We're not going to be talking a lot about benefits today, but we have other videos in the past that you can take a look at that we do talk about benefits quite a bit. And I've been in the industry for 14 years. And I work a lot with female professionals and their family, figuring out how we take these benefits and make it work for your planning and do personal planning. Okay, so let's get into it. So what does market volatility means? And just FYI, if you see me look down, I'm looking at my notes. According to Bankrate, market volatility refers to the degree to which the price of a security or index change over a period of time. Okay, so it's basically that up and down feeling you get on a roller coaster sometimes that can feel like investing. It's sometimes sudden, it's sometimes gradual. It's the same. Is this the same as a market pullback? Not necessarily, right? That's the thing that people don't understand is when they hear volatility, they think of it as always negative, and it's not always that. It's both up and down, right? So a lot of people will say that market volatility is just the nature of actually investing, that, it's experience, is what happens in markets in general. And we don't often have 20% downturns as often, so they're not necessarily part of market volatility. That is actually a downturn in the market, not the traditional market volatility that we're seeing. It can make you emotional, to be honest. And so if you look at your accounts often, it's good, but you have to keep that in mind that, your values are going to change day to day depending on market volatility. And we've been seeing a lot of it in the beginning of 2025. And like I said, it's not necessarily bad things. Sometimes you can have market volatility and it goes up ultimately, right? It's about the big picture, not the day-to-day stuff. So what causes market volatility? And there's the Bankrate article, or the definition that I talked about is in the article that's linked on the screen. I'll also put it down on the notes for the YouTube video. But again, Bankrate says market volatility can occur for a variety of reasons, including bad economic news such as rising unemployment, actions of central bankers such as the Fed Reserve that I've talked about in the past, unexpected shock such as soaring oil prices. In some cases, volatility is simply the result of volatility, as panicked traders race to sell before other traders, leading to a stock market crash. So you can kind of see that market volatility is all over the place. It could be something that just is a daily thing, like we get bad unemployment numbers, and then the market will recover. within a day or two or something like that nature. Sometimes you get, big surges upward, like the day after President Trump won election in 2024. We saw a huge run up in the market. I believe it was the day after. I'm not 100% sure, but I believe it was the day after. So you can see it in both directions. And, we've kind of settled out. It wasn't just, just didn't stay up there and keep going. It settled itself out. So a lot can make the markets move. And if you read the article of the day, whatever's out there, everybody is always trying to give a reason why the markets move, right? They always feel like they have to have a reason of why it's happening. And is that always true? No, because you've got to keep in mind that investment news are business and entertainment. They want readership, they want listeners, and it's like I said, it's a form of entertainment. So they want you to keep reading. So they're going to make guesses, maybe educated guesses. Maybe they're not guesses. Maybe they are true. But you will have to keep that in mind when you're reading things and keep an open mind on the markets when you are going through these times that are very emotional, because the article tries to evoke emotion out of you. Okay. All right. So the impact of volatility on investors. This is the real meat of what you need to know. Okay. So stress is really the impact of volatility on the investors. You watch the ups and downs in the market and it scares you, and you look at your accounts, and people tend to look at their accounts a lot more when we're going through a volatile period and it's in the news a lot versus when things are just doing fine, and they don't look at it at all hardly during times like that, from my experience with people that I work with. The fear of making a mistake and taking on short-term moves on deciding on long-term plans are really the problem, is that you could be acting out of fear, making kind of very big decisions in a very short period of time based off of emotions. Maybe you don't like this administration. Maybe you love this administration. Maybe, like that kind of stuff can really cloud our judgment. And we make decisions on really what should be a long-term planning decision very quickly and can hurt ourselves. So, I always say when we're going through tough times in the market, there are 4 reactions that we get from clients. I won't look at my accounts to get through it. Add more money. I am afraid of losing money. Should I change course? And I know I should stick to my planning, but I need to talk it through with somebody. Okay. And I would say all these reactions do not make you a better or worse investor. They have I have some very emotional clients, and I have other clients that are very level headed. And sometimes they flip flop, right? I have very level headed clients that go crazy when something happens. I have very emotional clients that very level headed in other times. So volatility can really bring out all sorts of emotions on us. I think the big thing is to recognize the emotion that you're having and the reaction, and think whether or not it's helping your long-term planning. Okay. If you have a shorter time horizon, you're going to have a different reaction than you have a longer time horizon. And acknowledge how you're feeling. Keep an open mind. Make sure you have sincere conversations with your advisors to get you through the emotions that you're having right now, so that you're not making decisions on things that are not the right decisions for a long-term plan. And even if you're in retirement, just FYI, people say, oh, I'm 5 years from retirement. You're still going to live, let's say 30 years in retirement. So you're still got a long-term of planning. Okay. So you've got to think of not just, retirement as your end date, but you've got a long-term plan after that as well. Okay, so staying informed. Should I be looking at my accounts or ignoring them during times like this is what I get asked all the time. And it really depends. I'm going to tell you to lean into information during times like this definitely can stress anybody out. It stresses me out as well. And I'm, been doing this for 14 years and I read lots and stuff. So I would imagine the average investor is very stressed out when they're reading things about the markets at this time. And so if you want to keep informed, just try to keep a big world view on this. And I think it's also good for you to continue to be informed during good times as well. Don't just keep being sucked in during market volatility when there's a lot of chatter. And so have discussions rather than taking action off of something that you're reading. Have a conversation with your advisor, with whoever you lean on for investment advice at that point and with your planning. Stay informed, but try to stay very controlled in the actions that you're taking. Do your breath work, breathe in and out, right? And it's always important not to read propaganda that investment news can put out there because, like I said, they're entertainment. They are a business trying to get you. They want readerships. They want viewers. They're gonna put stuff out there that might or might not be true for your situation, that might just get the biggest amount of views on it. So you just got to keep that in mind. All right. So this is probably the most complicated slide. I did put the link to see the full article in it, but I thought that this was a really interesting slide to take a look at. So many times, people think that being a good investor is selling out right before a bad time happens and getting back in when the dust settles, right? And the problem is it's very hard to time the market. We've all heard those stories of people who've gotten out of the market right before it crashed, but we don't hear the story of how to get back into the market. And that's where people can really lose money in the long run. And so if we take a look at this chart from Visual Capitalist, you're going to see what missing some of the best days are. Okay. And some of those best days are maybe those days that you are sitting in cash. I said maybe because obviously every single volatility phase is different. Every single downturn phase is different, that kind of thing. But you can really look at this and see how it can hurt your returns. So look at the bottom. When the best days in the market were in 2020, it was in March 13th and April 6th of 2020. That was right in the middle of lockdowns. Who knew that those were going to be your best days, right? We just started the lockdowns at that point, and the market started to turn and have really good days during that time. If you were sitting in cash because you got scared of the economy, of all the chatter, I mean, it was so much noise during that time, you could have missed those two big days. A lot of people did, unfortunately. And you kind of saw where the market started to stabilize during that time, which is strange, right? And you can kind of see on this graph that missing just a few days off the best over 19-year period is very catastrophic to your portfolio. And like I said, I really encourage you to go see this on its own. Just click on the link. I'll have this in the description as well. But the idea is that sometimes sticking through the pain is worth it overall, because you might miss the bad days, but you also might miss the good days that can counteract those bad days. And so with that, that is our market volatility talk. I hope that helped. I don't know if anything that I said was groundbreaking and maybe you had not heard before, but sometimes it's really good to have this as a reminder. So I would tell you, if you found this helpful at all during this kind of tumultuous times in the markets, keep this, as part of your list, and keep coming back to this video to kind of talk you off the ledge and to remind you to think things through on the big picture scale. So like I always say, take a deep breath. Volatility is part of investing, and then find out where it works for you and remember how you got through the last time. And maybe that was the right thing and maybe it wasn't, but you need to reflect on your past. And with that, if you'd like to schedule that call, you can use the QR code. You can go to our website and use the link there to schedule time, and just email us at info@onevisionretire.com. That comes to both Chris and myself. And if you just want to see what we're talking about, I am pretty active on LinkedIn, so you can always follow me there. And with that, have a great one. Try to stay calm during these kind of tumultuous times, and we will see you on the next video. Bye-bye.